gold is pretty expensive. From a monetary point of view, gold is still very cheap. Valued against equities, gold is also pretty cheap. But I think, in the second half of this, what we call golden decade, our take is that silver, mining stocks, and commodities will actually outperform gold. So gold always goes first, and then with a slight delay, silver, mining stocks, and commodities are catching up. And I think this is really now one of our core views, that you should actually overweight those performance gold assets that are still, quite seen quite pessimistic in market.
Gold prices keep hitting new highs, and Ronald-Peter Stöferle, author of the In Gold We Trust report, breaks down why. He mentions something exciting is happening with gold right now. It just doesn't want to go down. Gold has always been more than just a shiny metal or a luxury good. It is a symbol of wealth, a store of value, and more importantly, a financial haven during times of uncertainty. As we step into 2025, the economic landscape is shifting under the weight of new challenges. Adjusting interest rates, persistent inflation, geopolitical tensions, and volatile currency markets. Gold isn't always a guaranteed winner. In robust economic periods, equities can outperform in both the short and long term. From 1971 through 2024, the stock market's average annual return was 10.7%, while gold's was 7.9% over the same span. Currently, gold remains a stable asset amid high market volatility. Prices have reached record levels, climbing over 25% since early 2025, driven by persistent inflation and economic uncertainty. Ronald-Peter Stöferle believes that gold's strong performance shows many investors are still waiting to jump in. He's confident that we're already in a gold bull market, although it didn't just start. As we move into the second half of what he calls the golden decade, he expects silver, mining stocks, and other commodities to outperform gold even further. He thinks now is a great time to invest in these areas because most people aren't paying attention to them yet, making it a brilliant opportunity for those who are. We're about to explore the video, but first, be sure to subscribe and click the bell icon to stay up to date with our latest uploads. Your feedback in the comments is always appreciated.
The interesting thing is it just doesn't really want to come down. Let's not forget, Steve, that at the beginning of the year, gold was trading at 2,600. Let's not forget that 1 year ago, gold was trading at 2,300. So this has been a massive move. So it just really doesn't want to correct or consolidate any lower, which is telling me that there's quite a lot of interest waiting on the sidelines. People are buying the dip, and I think this is primarily Western financial investors that completely missed the gold train over the last couple of months. They are buying every dip. And what's very encouraging is the fact that gold was trading at 3,500 a couple of weeks ago. Obviously, it has corrected slightly, but during that process, sentiment completely cooled off, and it's even in very bearish territory now. Commitment of traders report has improved, so definitely less speculation, which is a very, very positive sign. So from my point of view, perhaps the next couple of days, couple of weeks will be somewhat of a sideways trading. The seasonals are not really supportive, but I think that we will definitely see by the third or fourth quarter of this year new all-time highs. Gold has a very high stock to flow ratio, which is basically the inverse, means that the gold supply inflation is very low. And we crunch the numbers since the year 1900. There's 1.5% inflation, annual inflation in gold supply every year. So basically, if you own an ounce of gold, every year there's like 1.5% more gold being mined. And this number is very, very stable. So Bitcoin, gold has a extremely high stock to flow ratio, and actually Bitcoin now has an even higher stock to flow ratio. And this is what really differentiates gold as a monetary asset to commodities like copper or oil or whatever that have a very low stock to flow ratio. Now, when it comes to counterparty risk, I think we're seeing some sort of a bear market in trust. We once wrote a report called Gold and the Erosion of Trust. Well, we actually said back then already that there's an erosion of trust, not only in finance, but also in the society in general. People don't trust in institutions, science, obviously politics. And I think that gold is some sort of a mirror to that development because, as you rightly said, gold is 100% possession without any strings attached. And that's really the beauty of gold. As long as you hold it in a physical form, if you're talking mining stocks, for example, that's a completely different risk set because everything that can go wrong in a mining project will go wrong at some point. And you've got equity market risks, you've got management risk, you've got geological risk, you've financial risks, infrastructure, First Nations, whatever. So I think that's always this is why we differentiate between what we call safe haven gold, which is physical gold, and then on the other hand, what we call performance gold. This is primarily silver and mining stocks. So therefore, I think as long as we're seeing this erosion of trust, there's a very, very strong case for gold being made. And as I've said, this mirror is telling us basically that there is globally now an erosion of trust that will probably or unfortunately continue. Gold is pretty expensive. From a monetary point of view, gold is still very cheap. Valued against equities, gold is also pretty cheap. But I think, in the second half of this, what we call golden decade, our take is that silver, mining stocks, and commodities will actually outperform gold. So gold always goes first, and then with a slight delay, silver, mining stocks, and commodities are catching up. And I think this is really now one of our core views that you should actually overweight those performance gold assets that are still, quite seen quite pessimistic in markets, because who actually is bullish on silver outside of the silver community? Who's actually bullish on mining stocks? Which generalist investors are nowadays attending mining conferences? And then, if you have a look at the fundamentals of the mining space, there's just free cash flow monsters. They've sold off. They reduced their debt. Their balance sheets are in great shape. We've now seen some really good M&A deals, but we haven't seen any big takeovers by the majors yet. This is going to happen. We're seeing that silver is in the fifth year of supply deficits, the fifth year in a row. So therefore, I think now is really time to be heavily overweight silver as well as mining stocks, and also to some degree commodities.
In 2022, central banks purchased more gold than at any time in the past 5 decades, with over 1,000 tons bought annually since then, a trend that is likely to continue. According to the World Gold Council's Q1 2025 report, central banks are expected to remain net buyers of gold as they seek to diversify reserves and shield themselves from currency volatility. Back in 2007, when gold was trading around $600, people often dismissed it by saying things like, "Gold doesn't pay interest," or "You can't eat it," or "It doesn't do anything." According to Ronald-Peter Stöferle, people continue to make those same arguments today. But what's changed, he said, is who's driving the gold market. This time around, the real demand is coming from emerging markets, not the West. While gold is often seen as a commodity people buy when things fall apart, like a crisis hedge, Stöferle believes there is now a strong and positive reason to own gold, mainly because people in fast-growing countries continue to value and save in it. Now, let's redirect our attention to a video.
When I published my first In Gold We Trust report, I was still a young analyst working for a bank. I think the first couple of reports were pretty basic because nobody actually teaches monetary history. Nobody really teaches on university or in school anything about sound money, the Austrian school of economics, and so on. So during my writing, I actually discovered all those topics and actually took the red pill basically. And I think the discussions that I had since then were, I've often heard back then when gold was trading at 600, yeah, but it doesn't pay any interest and you cannot eat gold and it's an unproductive asset. And I'm still hearing similar arguments. And I think the major difference between now and back then is that this bull market is clearly driven by emerging market demand. And I think that people often forget it because gold is often being marketed as a, let's say, a catastrophe hedge, something that goes up when everything else goes to hell. But actually, there's a very positive case for gold being made. Gold is a low beta emerging market asset, and the majority of demand is nowadays coming from emerging markets. I was in Saudi Arabia in January. I traveled to Turkey quite often. I'm in Dubai, in the Middle East, in China, in India. And if you go there, if you talk to people, if you just walk around, you can tell that gold has a much higher importance for people there. And with the growing economy and higher savings rates, some sort of a natural tailwind from those countries that actually prefer real physical gold. So basically 2/3 of the gold demand is coming now from emerging markets. And that's a big difference compared to 2007 when I wrote my very first In Gold We Trust report. It's not going to have a big impact. I think people kind of mix up the topic of HQLA and tier one asset as well as tier one capital. So it's a little bit technical, but Steve, I talked to many bankers all over the globe. What's going to happen on July 1st? And I can tell you for treasury guy sitting at the trading desk of a bank, for an asset liability manager, for an investment banker, actually they couldn't care less about gold. It's just not, it's just not something that they're really interested in. So I think this is heavily overemphasized in the gold world. So from my point of view, and that's probably quite an unpopular opinion, from my point of view, it's quite a non-event.
From the U.S. presidential election to ongoing conflict in Ukraine and rising tensions in the Asia-Pacific region, 2025 is shaping up to be another volatile year geopolitically. Historically, such uncertainty has tended to boost demand for gold as a haven. Despite aggressive rate hikes by central banks over the past 2 years, core inflation, particularly in areas like housing and energy, remains stubbornly high. As a traditional hedge, gold is increasingly seen by investors as an insurance policy against ongoing inflationary risks. As global risks rise, do you view gold more as an investment or as a hedge against risk? Share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates.